Implied volatility is shooting higher, which could mean it's a good time to be on lookout for iron condor trades. An iron condor aims to profit from a drop in implied volatility, with the stock staying within an expected range. When implied volatility is high, the wider the expected range becomes. The maximum profit for an iron condor is limited to the premium received, while the maximum potential loss is also capped. To calculate the maximum loss, take the difference in the strike prices of the long and short options, and subtract the premium received. Traders should have a neutral outlook on the stock and ideally look to enter when the stock has a high implied volatility percentile. First, let's look for stocks with a high implied volatility percentile. We're in the thick of earnings season, so many stocks will be showing high 4. We can see that Microsoft MSFT has both a high 4 percentile and 4 rank, so let's use that in our iron condor screener. MSFT iron condors. Let's take a look at the first line item. Using the January 28 expiry, the trade would involve selling the 290 put and buying the 260 put. Then on the calls, selling the 320 call and buying the 350 call. The price for the Condor is $5.51, which means the trader would receive $551 into their account. The maximum risk is $2,449 for a total profit potential of 22.5% with a probability of 88.1%. The profit zone ranges between 284.49 and 325.51. This can be calculated by taking the short strikes and adding or subtracting the premium received. The second example also uses the January expiration and has a 32.98% profit potential with an 84% probability of success. Microsoft is due to report earnings on January 25, so these iron condors would have exposure to earnings. Google iron condors. The second stock on our high implied volatility screener was Google. Let's look at the first line item using the January 28 expiry. The trade involves selling the 2,640 put and buying the 2,440 put. Then on the calls, selling the 2,840 call and buying the 3,040 call. The price for the Condor is $33.70, which means the trader would receive $3,370 into their account. The maximum risk is $16,630 for a total profit potential of 20.26% with a probability of 68.5%. The profit zone ranges between 2,606.30 and 2,873.70. This can be calculated by taking the short strikes and adding or subtracting the premium received. Google is due to report earnings on January 25, so these iron condors would have exposure to earnings. Visa iron condors. Visa is another stock with both a high 4 percentile and 4 rank from our initial screener. The first example uses the February 4 expiry and involves selling the 205 put and buying the 195 put. Then on the calls, selling the 215 call and buying the 2,255 call. The price for the Condor is $3.98, which means the trader would receive $398 into their account. The maximum risk is $602 for a total profit potential of 66.11% with a probability of 54.2%. The profit zone ranges between 201.02 and 218.98. Visa earnings are set for January 27. Mitigating risk. Thankfully, iron condors are risk-defined trades, so they have some built-in risk management. Position sizing is crucial to ensure that minimal damage is done if the trade suffers a full loss. One way to set a stop loss for an iron condor is closing the trade if the loss is greater than 1.5 times the premium received. The first example on MSFT received $551 in premium, so a stop loss could be set if the trade is down $825. Iron condors can also contain early assignment risk, so be mindful of that if the stock breaks through the short strike and it's getting close to expiry.